What if I told you that the financial markets you trust are not what they seem? Behind the flashing numbers, the stock tickers, and the trading apps, there exists a world most people will never see, a world where decisions are made in shadows. Fortunes are manipulated, and ordinary investors are quietly left out in the cold. This is not a conspiracy theory. It's the reality of modern finance, a system built to reward insiders and punish those who don't have access to the levers of power. The mystery is simple yet chilling. Why do crashes happen seemingly out of nowhere? Why are certain companies or sectors allowed to skyrocket while others collapse without warning? And why, despite billions in regulations, do financial scandals repeat decade after decade in country after country with strikingly similar patterns? Today, we're going to uncover the dark side of financial markets. The forces that few admit exist, but which shape the wealth and lives of millions every single day. To understand the dark side of financial markets, we need to go back centuries. Money and markets were never were always instruments of power. In medieval Europe, banking families like the Medici and Fuggers controlled trade, currency exchange, and lending. Their wealth allowed them to influence monarchs, wars, and entire economies. Fast forward to the 20th century. The creation of central banks, stock exchanges, and investment institutions seemed to democratize finance. Anyone could invest, trade, or grow their wealth on paper. But beneath the surface, the system remained concentrated. The players changed, but the rules of influence and control persisted. Governments, major banks, and hedge funds became the real arbiters of wealth, capable of steering markets in directions ordinary investors could only react to. And the twist, every time markets appeared free, the underlying mechanisms were anything but. Insider trading, shadow banking, high-frequency trading, and derivatives markets created layers of complexity that most people could never understand. Complexity became a tool of control. The modern dark side of financial markets, deep to appear overnight, evolved from the early days of speculation and credit expansion. In the 1920s, the United States experienced a massive stock market boom, fueled by easy credit and speculation. Ordinary citizens were encouraged to buy on margin, borrowing money to invest. It felt like prosperity until 1929. The crash wiped out millions, but the people in power, Wall Street insiders, and large banks were often able to recover while small investors were ruined. Post-World War II, financial markets became more regulated, but new mechanisms emerged. Hedge funds, private equity, and complex derivatives allowed the wealthy to exploit loopholes. The 1980s and 1990s saw the rise of leveraged buyouts, aggressive trading strategies, and the globalization of finance, creating a system where market volatility could be engineered for profit. By the early 2000s, the financial system had become a sophisticated web of leverage, automation, and opaque products, collateralized debt obligations, credit default swaps, and other instruments, allowed massive profits and massive risks to be concentrated in the hands of a few institutions. The 2008 financial crisis was the inevitable breaking point. Banks had bundled subprime mortgages into complex products, selling them across the globe. Rating agencies, government oversight, and investors failed to see the risk or ignored Italiano. When the housing bubble burst, trillions in wealth evaporated. Millions lost their homes, and yet the institutions at the center of the collapse were bailed out. Ordinary citizens absorbed the losses, while insiders often profited through government rescues, short positions, and opaque financial maneuvers. The lesson was clear. Markets are not always meritocratic. They are controlled by those with access, information, and power. And the mechanisms that created the crisis were not eliminated. They evolved. Since 2008, financial markets have entered an era of extreme manipulation. Central banks print trillions in quantitative easing programs. Hedge funds execute trades that last milliseconds, taking advantage of ordinary investors' slower reactions. Algorithms and AI-driven trading can cause flash crashes in seconds, erasing millions of dollars from accounts before anyone realizes what happened. Global debt has reached record highs. Governments are major players in markets through stimulus programs, bond purchases, and direct intervention. And yet, the narrative remains. Markets are free, efficient, and so the reality is far darker. The system often operates to protect insiders, preserve power, and maintain the status quo. Ordinary investors are left to gamble in a game where the rules are stacked against them. The consequences of this system are visible in every corner of society. Wealth inequality has skyrocketed. Millennials and younger generations face record student debt and stagnant wages. Housing markets are increasingly inaccessible. Retirement security is uncertain, and financial literacy alone cannot protect people from structural manipulation. Every market crash, every debt crisis, every insider scandal disproportionately impacts those who do not have access to the inner workings of finance. And history shows that without systemic reform, these cycles repeat. Governments and regulators have tried to correct these abuses sometimes after catastrophic crises. After 2008, reforms like Dodd-Frank were implemented in the US, and Basel regulations were tightened internationally, but many loopholes remained. Shadow banking, derivatives, and high-frequency trading continued largely unregulated. The reason is simple. The system was designed to protect the powerful. Any attempt to curb abuse often faces resistance from those with the resources and influence to maintain their advantages. The result, reforms are often cosmetic, enforcement is inconsistent, and the core mechanisms of control persist. Look around today, and the patterns are unmistakable. Meme stocks, crypto markets, and speculative bubbles repeat the same dynamics. A small group of insiders has a massive informational advantage. Markets are volatile by design, and ordinary participants absorb the most risk. Global crises from COVID-19 stimulus interventions to inflation. Spikes demonstrate how central authority can steer markets in ways that enrich some while penalizing others. The lessons of 1929 and 2008 repeat, with new technology and new instruments adding layers of complexity that most people cannot easily comprehend. Financial markets are not neutral. They are structured systems with rules designed to protect insiders and influence outcomes. Awareness is the first defense. Wealth is increasingly concentrated, and access to information is a key tool of power. Ordinary investors must recognize the limits of individual control in a highly manipulated system. Understanding patterns of manipulation, historical cycles, and structural risks can provide strategic advantages. Diversification, skepticism, and financial literacy are more critical than ever. The greatest mistake is believing that markets are fair. They are not inherently meritocratic. They are influenced, manipulated, and controlled by actors who operate in shadows. Recognizing this is not pessimism, it is preparation. Knowledge is the key to avoiding the traps that have ensnared generations of investors. The question is not whether these dark forces exist, they have always existed. The real question is, will you navigate the financial system with awareness, or become just another casualty of its hidden design? If you want to uncover the hidden mechanics of finance, understand market manipulation, and learn how to protect your wealth from unseen forces, hit like, subscribe, and turn on notifications. Each week, we dive into the secrets that govern money, power, and global markets, revealing what most people never see. Because in the world of finance, what you don't know can cost you far more than what you do.